Welcome to the Dividend Talk podcast, episode 124. Three very important metrics to us when analyzing stocks. Hey guys, welcome back to another episode of Dividend Talk. Today we're going to talk about three important metrics for both of us that we use when analyzing dividend growth stocks. All that and more. See you on the inside. Good morning, European DJ. How are you this weekend, buddy?
Hey, good morning, EMF. I'm doing well. Not so bad as you, as I can see. After was it a long party?
Yeah, as you highlighted on Twitter, I have a very active social life at the moment. So we have just had a wedding this weekend, and I don't know what it's like in Europe, but I do know that Irish weddings are at least 2 days, and it's more about the drinking and less about actually the marriage itself. So it's fun, it's good, but today is going to be a little bit of a struggle for me, I'd say.
Well, what can I say? You look still pretty for your age, so I think you'll do well. And when it comes to weddings, I mean, Polish weddings are the best. I mean, mine started at 6 p.m. and lasted till 5 a.m. Lots of food, drinks, and dancing. So yeah, I can imagine if it's something like that closer than Ireland, then it must have been a great party.
Yeah, it finishes up around 5, 6 a.m. and then you're back at about 10, 11 the next day, and you go till you can't go anymore. So yeah, that's
nice.
That's Irish weddings. But hey, we're not here to talk about drink. I'll be making everyone thirsty on the run. So let's have a little look at the news of the weekend. I seen one that you put in there, and I don't know how true this is, but Apple want to buy Manchester United. What?
Yeah. So what? I mean, we're both football fans, right? So Manchester United, first of all, they sacked Cristiano Ronaldo after the interview. But secondly, on the same day, they announced that the Glazers, the majority shareholders of Manchester United, are putting the company for sale. So straight away, there seems to be an English bloke that is a billionaire that seemed to be interested. Dubai are also interested, but also that Apple would like to own an equity stake in Manchester United, and for instance, totally revamp the stadium that they have there. So, there's probably in the topic of gossips, but from one side, I could see actually a really good fit. Apple buying a sports club like Manchester United. I mean, two big brands in the world. One is fallen behind. I mean, how easy Apple could do something with this club and really generate revenues about that, and also think about the branding, having Apple on the shirt continuously there, having it called the Apple Stadium. I mean, I could really see a good fit there. Of course, as a shareholder, I don't believe investing in sport clubs is really the best, because you're investing in something that's called emotion. On the other hand, if you see how well the return on investments have done on football clubs for many of the rich guys, I think there might be at least some potential there for return on investment.
Yeah, but you look at how much Manchester United was bought for. It was hundreds of millions, not billions, and now they're looking at selling it for upwards of 5 billion. I just can't see this being a good fit for anybody. Like how do you make money off that? And it's the same with Liverpool. Liverpool are up for 3 or 4 billion.
Yeah,
like we were bought for 250 million. Who in their right mind is going to go in and spend 4 billion, knowing that you still have to revamp the stadium, buy players? You're not guaranteed to get Champions League football.
Yeah.
It's crazy. Like eventually,
but we thought the same probably when Manchester United was trading in the hundreds of millions, right? So this seems to be only going up at the moment, and it's crazy how much money is going into football. It's really, really crazy, and there are just few clubs that can be profitable, like Bayern Munich and such. But the equity values have gone up dramatically in the Premier League, right? Because people are just watching it, buying television subscriptions. So it is one of the best sports assets in the world, I would say.
Yeah. Still, Apple, stay away from Manchester United, please.
Yeah, I thought it's
Uh,
a nice gossip here because Manchester United pays dividends as
yeah,
well.
yeah.
Yeah.
I don't care. I don't care. Anyway, Disney have released some big news. Bob Iger has returned, and the question is, will he reinstate the dividend? I mean, that was on a lot of people's minds this week, I believe.
Yeah. I mean, I have no clue. I'm just a big fan of Bob Iger. I mean, he's to me in the category of Howard Schultz, famous CEOs that brought companies really into the stratosphere and where their successors are struggling. Yeah. And they are usually own hand-picked successors. The same
Yeah.
was with Howard Schultz at Starbucks, now also with Bob Iger. And they have to come back again, right? Because, yeah.
I don't like it though. I don't like having to go backwards. I mean, you should be able to progress, and if you have to go back to the same guy, it's like when Chelsea brought back Jose Mourinho. It didn't work
Yeah.
out the second time around, but I mean, I don't really like having to go back to a previous CEO because the current CEO is doing a shit job.
Yeah, but it shows how rare visionary CEOs are
Yes,
that really understand the business, have a vision for the business. Because this Bob Chapek or something like that,
yeah,
effectively he was doing what Bob Iger laid out as a plan for the last 3 years. Yeah, but he did it without any, I said, without
conviction.
any character, conviction, or charm behind it, right? Because the
Yeah,
numbers he spit out with Disney Plus are amazing. I mean, he single-handedly got Disney Plus launched on numbers that Netflix is even stressed about.
yeah, yeah. I get what you're saying. On one hand, understand, yes, he's a great visionary, but as a company, he's not going to be around forever either. He has to move on at some stage, and
Yeah, yeah, yeah,
you
yeah.
you you won't always have that to fall back on. So you need, I think, you just need to keep moving forward. Maybe bring him in as an advisor, maybe. But I mean, look,
But what is advisor? Yeah, then you have kind of the old guy, the old legend watching over your shoulders. That's also not a healthy situation, right? So
yeah,
yeah,
true.
I'm probably the criticism we can have on both Howard Schultz and Bob Iger is that they didn't build a business to last that any idiot can run.
Yeah,
Yeah, that's Warren Buffett's definition.
exactly. Yeah, it's look, it's great, and it's generated a lot of buzz around Disney at the minute. But I don't buy in having to go backwards. I really don't.
Yeah.
I'm sure he'll do a great job. And as I said, the question was, is he going to reinstate the dividend? I suppose the real question is it right to reinstate the dividend? Is that the right thing to do?
Yeah. I don't even waste my brain capacity on that until they have reinstated it. Then I might look into it again. But until that time, not even going to waste time on it. I just found it interesting because Bob Iger for me is in the top 10 CEOs that I've observed when analyzing companies.
Yeah.
Yeah.
Yeah. Awesome. And then the last piece of news I had was something I thought was interesting about Louis Vuitton. I know we spoke about them a couple of times throughout the show,
Mhm.
but they're opening the first furniture and homeware store in Shanghai. So the world's first store in Shanghai, which is quite interesting. You always, Louis Vuitton, I think of bags and designer, and now they're obviously opening a designer furniture store. So
Yeah.
it'll be quite interesting to see how that plays out.
In the middle of the lockdown. So same store sales will be really high next year compared to
Yeah.
this year.
But
Yeah.
I mean, I
Does
don't
it
know
feel like
about you.
diversification for you? Like,
It
yeah.
does a little bit. Like if I'm buying furniture, I just want comfortable, and I just see designer as chic and all this really odd shit. No, like I just find it awkward. I don't know how it's going to fit into the average person's home.
But what? Yeah,
May-
okay, but it's not about the average. What if you're like the new rich in China, where there are quite a few of, quite significant few, right? So you know, it's like, I mean, it's almost like the old colonists going through the other islands and selling some shit to take the gold from there, right? So
Yeah.
uh,
Well,
it's almost, yeah.
they've thrown out some figures here, so they reckon that the home sector will grow roughly around 800 billion by 2026. Like that's massive.
Yeah, I think they're onto something, and I think that they try it out is good as long as it is not a major part of their investment case of their cash flow now. But I think there's a space for it. Yeah, I think there's really a space for designer furniture.
Yeah, we'll see. I just doesn't seem like a good fit for me, but what do I know?
Yeah.
What do I know? Exactly.
Yeah. Good. Also, we had few dividend hikes this week again, so let's quickly touch on those. And Brown Forman on the B shares, so it's a ticker symbol BF dot B. They declared a 9% dividend increase, so currently trading 1.16% yield, so that's not too much. But when we talk about Diageo, I think we have a nice competitor here. So, what do you think about these kind of dividend hikes?
I mean, it's a company that is very, very little spoken about. I don't know if I've heard anyone talking about this company. 9% dividend increase, 39 consecutive years of dividend like they're a dividend aristocrat. It's amazing. They've got some Jack Daniels, which I'm familiar with, and then they've got a lot of other ones that I don't know. But they seem pretty big in other parts of the world. There's some tequila. You're a fan of tequila. I mean, we do know that these like companies will do well, particularly in developing worlds as well.
Mm-hmm.
Like people are starting to come into a little bit more money and they're spending. And if it's anything like Diageo, then I predict good growth from them. What I do know about, I think I said this about Diageo, they've raised their prices recently, which took effect this week. I wonder if these guys are going to follow something similar.
Yeah, yeah. Yeah, I really like this company. It's just the yield that always turns me off. But other than that, if it ever trades at an attractive yield, I would love to have it in my portfolio. But same as with Jago. Okay,
Yeah.
and the next one then is one of my darlings, is HPQ, HP Inc., our printer producer and notebook producer. They hiked the dividend by 5% and it's currently trading at a 3.5% yield. Let's not even talk about the buybacks that they have been doing and continue to do. So it's like a cash generating company. I'm okay that they do a 5% hike. They could have done more, but still, if you think about the company and its value, I think it's good that they have a proper mix of buybacks and dividend payments. Yeah. So I think this 5% hike is just purely even at a flat dividend payout. Just the buybacks are generating this hike already. So it's really a good case of shareholder return.
They're still trading like at a ridiculous value as well, $30 or something. It's still quite cheap. So, and then the last one is Hormel Foods, ticker symbol HRL. They've made their 57th consecutive annual dividend increase, and this one was 6% increase, which is, again, for me, is quite decent.
Yeah, I mean, we're really talking about dividend porn here, right? With all these dividend hikes continuously. And they're thinking about inflation. These are not the inflation numbers, but over time, they have been doing this continuously. So this is just really wealth generating what we're seeing here. It's awesome.
It's incredible. Like over the last, I think we had this segment, what, about maybe 6 weeks or so? The amount of nearly double digit, even upwards 7, 8, 9% and double digit increases has been quite astonishing. Like I wasn't expecting it, particularly when you look at the market environment. We're talking about high inflation, we've rising costs. All this has been spoke about maybe this time last year. And now this year, we're starting to see double digit and high dividend increases. And you're really starting to see the major players in each sector. You're starting to see who the actual
the ones with strong brands, strong pricing power. If you can hike your let's say your prices just as much as your cost increases are, you still, based on your gross margin, keep money left at the bottom line. So I mean, this is what pricing power really is.
Exactly. Okay, on to the main topic. We are going to look at some metrics that we use, 3 metrics when we're analyzing dividend stocks. So I think for the first one, I always use is free cash flow. Free cash flow is very, very important to me. It's probably the first thing I look for on the balance sheet. So I use Kaifin. I don't know if you have, and I have it set up. I have a list of all the metrics that I look at, and free cash flows is number one. I look at both free cash flow growth and then free cash flow per share, because we know when they're buying back shares, that will grow as well.
Yeah.
So it's extremely important to me to see that growth, that they can afford to pay it, and that trend is always intact.
And how do you deal with what we saw over the last year? Many free cash flows got slammed because of working capital issues. Increased inventory that they couldn't sell.
Yeah.
How do you look at that when you're looking at the free cash flow numbers?
So typically then you're looking at the payout ratio there as well is linked in with that. So a lot of these companies, their free cash flow payout is normally around 40-50%, and then they got slammed. Yes, in most cases it was still under 100%. And I was happy enough. Once the stars goes over 100%, I start getting concerned. Then I'm thinking, okay, what's going to happen next quarter? So I pay a little bit more attention on a quarterly basis to see what's happening with the free cash flow. Can they recover? We had companies like Danone, for example. We knew the free cash flow was going to recover. And then in some cases, you look at past recessions, what's happened, and just use that as a guide. But I do just pay a little bit more attention to it when we see working capital increase and what's going to happen. So it's more of a quarter by quarter, but generally I only look at it at a yearly basis because I try not get bogged down on that. But it was concerning. It still is a little concerning when you get to a company that's 110% payout ratio. You're going, okay, shit, I really need to pay attention here because they literally cannot afford this dividend without taking on some extra debt.
Yeah, nice one. And I would definitely say free cash flow is king because it's one of those numbers you can least manipulate, right? Yeah. And I often look at also the 5-year trend because with free cash flow, there are many companies that have, let's say, a little bit lower margins or they have some one-offs in the free cash flow. So I do look at it over time. Yeah. And for instance, now when the free cash flows were slammed by working capital, I expect them, for instance, next time to sell out of inventory, and therefore the free cash flow is a bit up again. So it should smooth out over time. So the 5-year average free cash flow is important to me, but then I want to see that the last 2 years have been higher than the 5-year average, let's say.
Yeah.
Nice one.
Do you only look at 5? I tend to look at 5 and 10, both trends.
Yeah. I take more value out of 5 year than 10 years because often companies are not the same companies anymore like 10 years ago. And so it's easier for me when looking at the story of the stock to look at the last five years. Yeah, for me, it's actually, it's hard, right? So I don't have a top metric, but like 3 metrics that I typically look at, and it has been changing over time. It goes a little bit with the wind as well, like based on my learning, what I figure out, and what I learn. Yeah, the last one that I actually really started to appreciate over the last 2 years, when it was brought to my attention, is called economic value added, and this is a really simple metric in the end. It's like the economic value added is when the return on invested capital, let's say, is higher than the weighted average cost of capital. So I think we touched upon it on this show before a few times. So what I really look at is a company over time, just with their money they're investing, creating a bigger return than what the money costs. Yeah, and that's why people often say, like, and some famous investors says, like, return on invested capital is one of the most single important metrics from a value investing point of view. So I started to really look at it, and I can see that companies that year over year have a return on invested capital of like 15-20%, and they are really, really growing strongly. Unfortunately, they usually have low dividend payout ratios because they get rewarded by the stock market as well for really high things. But let's say like that, when there's a negative here, I really need to understand the story better. Yeah, and there are some stocks that I'm a fan of that have sometimes a negative, but then it might be a one-off or something like that. But generally speaking, I really want this to be well positive, let's say.
Is there a specific figure, or it's obviously probably case by case?
No, it needs to be in the positive, preferably more than 2% positive. It depends on the cycle of where the company is in. When it's a really slow growth company, I would like it to be more than 2%. When it's in this stage that it has all the tailwinds, I rather look at a 5% gap.
Yeah, nice one. I know. I think Warren Buffett looks at that as well. If I remember, it's in one of his books that I read. I don't pay too much attention to it, but I do know from starting to read and listening to a lot of YouTube that it probably is important. There's a lot of investors out there that use this, so it's always interesting.
Yeah.
I always get bogged down with that. So it's the return on invested capital minus the weighted average cost of capital, and I always get bogged down on that calculation, the WACC, and I tend to end up relying on sites like Guru Focus or something to get those figures, and I hate it. I hate it. I'd rather just be able to
yeah,
take
but
those values
often
myself.
where I get it from is you just go to the annual report, and often many companies they like put it there, and you know that the cost of capital in these environments are typically between 6 and 10%. So in doubt, you can just go for 10% and go to the high end. But for some people that watch the YouTube videos, and we build a stock analysis dashboard, right? It's one of the metrics in there. Yeah, and it's something. It isn't like a make or break, but it's an important part of the story, I would say.
Yeah. So a lot of my metrics are obviously around safety, dividend safety. So I spoke about free cash flow, and the next thing I look at is debt, the overall debt levels, interest expenses, debt to equity, all that. For me, debt is really important. I've learned over time. I've invested in some companies like AT&T, for example, where the debt load was too high, and look, the dividend was cut. Not expected. Well, it was expected, but it's something that I should have picked up on before investing in them, which I didn't. So for me, from my lessons learned, I always look at free cash flow first, and then I look at the debt levels. I want to see that debt reducing. I don't mind if there is growth there, because sometimes there's acquisitions or there's a reason for it to grow, but I need to understand why. Like, for example, we have JSK there, which is in our listeners' questions. Their debt, long-term debt, has gone from 15 billion in 2012 up to 19 billion in 2021. So I'd need to go and understand, why has that increased? What are they doing to increase that? Are they increasing that to pay the dividends? Well, then that's a no. Did they acquire a company? Well, then I can see why they increase it. So I find that really important, and I look at interest expense, because that's the minimum amount that they have to pay. And if they can afford that, I think I look at a value like 7 or 8 times their debt level, then I'm more than happy.
Yeah. So for me, it's also the same. I have this also what I call dividend safety, and of course mixed in with the payout ratio. And I said, what I hate are companies that are borrowing to buy back shares at elevated valuation. I mean, look at Meta, what they did. They have been buying back shares at $300, right? Massively, and it's trading now slightly above $100 or something like that. I mean, this for me is so stupid to damage your balance sheet on this. They could have better just bought a lot of companies and then see the stock price go down 60% or something like that. Then squandered your money on that, but at least you get some real assets out of it, right?
Yeah, it makes no sense. I'm not a huge look. There's always cases where it makes sense, but I'm not a huge fan of borrowing money to buy back shares anyway. I mean, use the cash flow you're bringing in. If you're not generating enough, don't bother buying back your shares.
Yeah, exactly. I think for me, the example is an exception is HPQ now that we just touched on, because here that's valuation that I can really see the case, and how you said, the interest expense coverage ratio is really healthy. Even if the interest expense would go up double or triple, they can still easily pay it, and also for the dividend, right? So I think that's really how you look at it then. Yeah, nice one. And that, for me, that one that I actually also really like is the Chowder rule. Yeah, so I pay to that one also actually quite some attention, because the Chowder rule is the 5-year average dividend growth plus the current dividend, and then for normal companies it should be above 12, and for utilities above 8. Yeah, for like that. Why I find this one really important, and the 5-year CAGR is really important when I also look at, can they continue doing that over the next 5 years? Because when Chowder analyzed that and backtested it, those companies were typically outperforming from a total return point of view, because they also had a really, I said, if you it's like a flywheel. Yeah, if you have this dividend, let's say of 3% yield and a 9% or 10% dividend growth, you're really talking about a lot of return, and you're also talking about getting really quickly to a 10% yield on cost. So for me, it's more probably even a valuation metric, like whether it's undervalued or not. But it's for me a really important one to understand, like, what can I get out of this stock? Because sometimes I see people buying dividend stocks at a 5% yield and it's growing like 1% for the next 10 years. I mean, I don't mind having 2 or 3 high yielders like that, but you just know that it doesn't give you anything else than really some current cash, right? So that's why I also look at this one, at least to understand, like, where are we with this company here?
Yeah, good one. It's something. Look, I've caught from you, but I don't pay too much. I have it in my little checkbox as like a tree mark or something, but I don't pay too much attention to it. It is a quite. I think particularly when you're starting out, it's always a good one because it gives you a baseline that you can follow, and
Yeah,
you can be
it's a
sure
simple one.
and if you're picking something within that range, 9 times out of 10 they're going to be a top quality company, and you can't go wrong. Ignoring valuation, that is. So I think it's always a good one for someone that's beginning to baseline to start with.
Yeah.
The last thing I look at is dividend growth history, but particularly around recessions. How did a company handle the last recession? Look, we know, you said it, going back 10, 15, 20 years is not always ideal, but you do get a sense of what happened with a company, particularly like companies like Stanley Black & Decker and Snap-on, that typically react the same ways in recessions.
Cyclicals, yeah.
Exactly. So I pay a lot more attention to that. How did they recover? What did they do when they started to recover their top line and bottom line? Did they cut the dividend? Did they keep it stable? Did they grow it? So I find that really, really important, particularly, as you said, for cyclicals. So I always look at that history, and then I think about the future. So I need to have one competitive advantage from, at least one. What is their competitive advantage that they can bounce back from a recession and continue paying the dividends to me? That's, I think, is important.
Yeah, it's a good one. And I think specifically this touches on European stocks as well. And that's why I'm still flabbergasted with Danone that they did it. And also with Castellum, totally out of the blue, right? And Danone, there was more stress around the stock. Castellum is really like this. We spoke about it, this investor, I think. But it shows you really the commitment to the dividend in under stress, because that's where you can have also some chickens there that quickly cut it.
Yeah, and sometimes it also gives you a feeling of how the company feel are going to do. So if they are quick to cut the dividend, they're telling me, lads, next 5 years, I don't think we can recover. So we need to preserve as much cash as possible. If they continue to keep it stable or better, raise it, they're saying to me, this is a blip in the road.
Exactly.
We're going to bounce back, and we're going to do that. So it also gives you a kind of an insight into how the company confidence in the business as well. What
and this is really, really why I love dividend growth investing, and why it really fits me so well, because your cash income is just kind of protected by that, right? By these dividend growth policies. Of course, they can cut the dividend, but buying those companies that have a proven track record, have an outspoken dividend policy, that depending on the nature of their industry are making sure that they are set up to grow their dividends over time, is so much aligned with our interest. And this is really why I love dividend growth investing.
Yeah, there is one flaw in most of mine, is that I rely on history. So 5-10 years, there's a lot of backwards looking and trying to predict the future. But there's obviously some companies that are at the start of their dividend growth journey. I'm always going to miss out on them, because I prefer companies that are a little bit more mature, probably at least 7, 9, 10 years.
You have Beatrice.
Yeah,
you own
we have
Beatrice,
but they're a spin-off of a company that has paid dividends as well. So they're not a pure company that's starting from scratch that has no history. So it's the one flaw I would say I have, but I prefer predictability as much as possible. I know we got a comment last week saying that 98% of all dividend cuts are predictable, and giving that, this should be a more predictable investment vehicle than say growth investing or property investing, all that kind of stuff. So
But maybe what's good to mention is that I don't buy simply because of these metrics, right? I always do a business analysis first. And this business analysis is where you go into the crystal ball, where you check, you check out their products. What can you learn from them? You check out what the growth factors are for this company. And based on that, I know it's still a little bit sucking on your thumb, but based on that, you make assumptions here for the future, and then you analyze over time whether those assumptions are coming true. So for every stock I buy, I have a one-liner like, "What is my investment thesis?"
Yeah.
And as soon as that one is broken, then I need to reevaluate.
I really like Tiago's blog because Tiago writes his thesis, and then he goes back 12 months later. Is my thesis playing out? And I really like that. He's so committed and so disciplined in actually doing it and putting it out there as well. So I think it's definitely worth following him. But I think it's a great trait and a great thing to do. Make your thesis, whatever, one-liner, two-liner, and then 1 year later, read that and then still see if the company is following that.
Yeah, exactly. I think that's how you become also really an owner of the businesses and an owner of your portfolio. And if you get surprised, that would be awkward. Of course, Castellum and Danone are two different specific Castellum, but generally you won't get surprised, right? And we spoke about it in the last podcast about the dividend cuts. To some extent you see them coming, but from the other extent you don't see them come, but at least you have done your homework, right? So you know better what to do in such a situation.
Yeah. Awesome. Okay, we'll move on to some listeners' questions.
Yes.
Okay.
Yeah, so the first one is from Salim. Yeah, and he's asking, like, if you had a good amount of cash on hand, would you buy now or would you wait for the promised crash?
I mean, I've always said this. No matter what I do or say, the opposite happens. So I just tend to buy. So if I had extra cash on top of my monthly installments, I would just phase it in. I wouldn't throw it all in now. I would phase it in. But we could be at the bottom of the crash. We could be just halfway through. Nobody knows. So I stick to my plan. Pay everything monthly as I do. If I have an extra, I would throw in. I would say divide it by 12, and put in that amount extra every month.
Yeah. So in the past, I had this kind of concept of a war chest, which I don't have anymore, because I thought like, in times when there's a dip, I can double down. But this was a lesson of timing the market, right? But to your point, I'm not yet having the courage to do lump sum investing. So I indeed also spread it out. And for instance, now we're almost at the end of the year, and the bonus that I got earlier this year has been all invested into the stock market.
Good. Yeah. Nice one. So we've got a couple of questions, one from Thomas and one from, I think it's M. Markovic, and around GSK. Are they worth investing? They've got a low PE yield. Dividend yield is 4.9, strong moat, and so on. So what's your thoughts around GSK?
Yeah, I've looked into GSK many times. I see the value play here, but I see it rather as a value trap. I just don't see the growth in GSK.
Okay. And what about their spin-off, Haleon?
That one is more interesting for me because it sounds a little bit like Viatris. So I started to look into that one. They do want to pay their dividend, right? So an initial dividend is expected to be at the lower end of the 30 to 50% payout ratio. I like such spin-offs actually, because often spin-offs like AbbVie has done really, really well. They go through a phase of high debt and trying to do this with the balance sheet, like Viatris, also a bit turning around, finding themselves as who we are as a business. So Haleon is something I have on my list to analyze, but I haven't made up my thinking about that one yet.
Yeah, Haleon. So when that spin-off happened, we have a JSK site here in Waterford, and that has transformed now into Haleon. So it's quite interesting. It's on my list as well to look at. I know from the guys working there that they're predicting a lot of growth, doing some good things. So it's one to watch. Like you said, normally companies make a spin-off to help high growth company. They don't want to lumber with all the depth and all the slow growth of the main company. So they spin it off and see if it can grow on its own. So it's definitely one to look at. JSK, I haven't looked at it in depth, so I don't know it as well as you do. But from a fundamental point of view, it's the debt to equity, as I said, it's over 200% for me. That's too high for me. I don't like that. A lot of the other metrics look okay. Revenue is growing. Gross margins are actually decreasing, so the net income is decreasing as well. This is a little bit concerning. Free cash flow, they generate a lot of free cash flow. That's the only thing I will say. They're generating nearly 8 billion in free cash flow. So it's the debt to equity and obviously the margin pressures as well, which will concern me. But fundamentally,
nice.
it would pass my screeners fundamentally, but whether I like him as a business is a different case.
Yeah.
We got a question from Tom. Your feelings on Canadian banks, strict regulations and long histories?
I mean, I don't own any banks. Bankers are wankers. But if there would ever be an exemption, I would go for Canadian banks. We had the Dividend guy also on the podcast, right? Yes, Dividend Rocks or something like that as well. And he made a great case for Canadian banks. And I've looked into them from time to time, like Royal Bank of Canada and such. And I think they have 5 banks. And I think those banks are really set up for the long term. They look like rock solid, not even comparable to European banks, and not having this management that is full of shit of themselves like in American banks. So for me, Canadian banks feel really like a safe haven. But the issue with that is like, this is the financial industry where we always think like this is safe haven until it isn't. Yeah. So what is it like? Are they growing on top of on the back of the consumers, and is everything becoming expensive? So this is always my issue that I have with banks here.
But you know, I've never met one Canadian investor that has a bad thing to say about their banks, particularly from a dividend growth or dividend point of view.
Yeah.
I've never met one that had anything negative. Actually, it's the opposite. It's almost like something of pride for them. Look at our banks. Our banks are this, and I think they're rock solid. They've have great histories. Looking at some of them, they seem to have good balance sheets. I know you mentioned Mike from the Dividend guy was on here talking about a couple of them. He has his own website, Dividend Stock Rocks, it's called, and analyzes these in depth. My feeling is I'm not from Canada. I can never get a sense of it, and I'm always hesitant in banks for that because we're scarred, particularly in Ireland with the banking scandals over here. So it's hard to get excited or hard to follow and invest in banks when you have history like we have over here. But maybe if I was Canadian and I was in their environment, I'd be a little bit more positive and upbeat. But fundamentally, yes, they look good. Emotionally, I just find it hard to get attached to banks.
Yeah, same here. Same conclusion. Nice one.
Daniel Cooper, views on VHYL as a long-term core holding.
Yeah, so we're talking ETFs now, right? And we also have a question later from Walter Adams about SCHD. So when I look at these ETFs, and let's say VHYL as well, what is really important to check here is like the holdings. Yeah, so also their how you say it, whether they're actually growing the dividend. And you need to really understand what the dividend policy, let's say, is. And when I look at SCHD, I love that one. That's for me the best one when you take into consideration the growth of the dividend plus the actual yield. So if I would be American, I will probably put the majority in SCHD. When we look at VHIL, I have a little bit of mixed feelings there, and it is something that I'm not investing in at the moment. I feel like my own investment style, where I buy companies at the right time that are growing a dividend, is doing me better. I mean, yes, you can of course go with VHIL if you really want to make it easy and and how is it? Focus on your ETF core holdings or only on ETF investing, let's say. I think it's probably a decent one, but it's not convincing me enough to really go into it. I guess that's it.
Good. I mean, there's a lot of talk about both of these at the moment. They seem to be quite popular, particularly SCHD. I've seen a lot of. It's crazy. You always see a ticker, and then all of a sudden there's a load of videos and articles around the same thing. So it's fresh.
And then you can't buy them in Europe.
you can't buy them in Europe. But one thing I found interesting is in relation to US. So you can buy from Ireland. You can buy US shares, but you have to set up a tasty trades account. It's harder to buy them through interactive brokers. And then you also have this tax that you have to worry about. So is it the US state tax or I can't remember what it's called. But basically it's 40% tax on anything over 60,000. Estate tax, I think it's called. What I had an interesting conversation with someone from Ireland recently as well, that this actually applies to our US shares in our interactive brokers account as well.
Yeah.
So all our shares, I didn't know this. I thought that if I pass away and my wife gets my portfolio, she can just take it out. But actually anything over 60,000 on my US shares, she will have to pay 40% tax on top of any Irish or European tax as well.
Yeah, but I checked that as well, right? But there's a difference here between theory and practical. If you pass away now, there's no way the IRS is understanding like where the tax has to be paid and everything. So your wife doesn't need to worry. She should just sell the portfolio and move on or continue, because it can happen. But I checked this even also more, and the IRS is also not chasing up people in Europe to say you need to pay inheritance tax and such.
Yeah, but it's still something to.
It's a risk now.
Yeah, it's a risk
that you need to take into account, but I don't think about it at all.
Yeah. No, it's just a conversation. I think it's, for me, it's definitely worth thinking about and having some sort of plan in place. Maybe she don't tell him I've passed away and withdraw it and whatever, and she escapes it. But it's definitely something to consider. But in terms of ETFs, as you said, it's harder for us to invest in these. I'm not an expert in these by any means, so I think what you say is key.
Maybe good to mention, right? If you look at it from a Chowder rule point of view, VHYL has a Chowder now of about 10. Yeah, so the current yield is like 3.95%. The management fee is 0.29. So let's say you get it for 3.6% yield, and then a growth of 6% annualized over the last 5 years. So this is the Vanguard, right? So I would say it is a good consideration, but don't expect distribution to be stable, let's say, because they haven't been stable either. Yeah, it's really depending on when you from what year you calculate the 5 year growth. Yeah. So give you an example. I believe it was in 2019. Yeah, let's check. In 2019, they paid like $7.6 in dividends. And then in 2020, they paid $6.7 in dividends. So you just had a dividend cut there of 15%. If that's not an issue to you, because you're an income investor, then it's fine. But we are always looking with our stocks from year over year dividend growth, right? And my entire dividend portfolio didn't get a 15% dividend cut. It was flat over the years, over that year, because we got the Shell dividend cut, the Disney dividend cut. We redeployed the money for Disney at a better yield, and other dividend payers grew their dividends that year. So overall, I did better than the VHYL, but of course, I need to maintain it myself and manage it myself.
Awesome. Jeffrey has asked us, do you ever purchase preferred shares? And preferred shares are shares that are paid out to shareholders before common. So we always invest in common shares. So preferred shares paid out before us, and if a company ever goes bankrupt, preferred shares
at the first right
will get money before us. So do you ever buy these?
No, but I remember looking into it when I just started, because the yields are always really nice. They're like 6-7% yield or something like that. Well, the normal share gives you 2 or 3% yield, but then I also saw that the preferred shares are not really ever growing. Of course, a little bit in share price, but not like the common ones. So that's why I didn't ever invest in it. But I remember in my first year, I was really looking at that one because, juicy yields at the time.
And you can just buy them on Interactive Brokers. There's nothing special.
I don't remember anymore. I'm talking about 5, 6, 7 years ago.
Yeah. It's, I never really thought about it. I looked into it, and I always thought that you'd have to invest X amount to be a preferred share, maybe 10K or 20K minimum, and you could only buy them at source maybe. But no, I've never thought of it. Never thought of using it.
Yeah.
Marek has asked us, what stocks do you see being like on Black Friday promotion?
Okay, so if there are currently any stocks on promotion, that's really hard to say. I think we just have a lot of stocks still on promotion compared to in the beginning of the year. But yeah, I would say HPQ is still for me on a promotion with $30. I would say Intel is on a promotion, but Intel comes with a lot of risk associated to it, so it's more like a turnaround. And maybe T. Rowe Price, I still feel it is on a promotion. Yeah, but not just a Black Friday promotion, just generally annual promotion.
Yeah, this was a lot easier to answer back about 4 or 5 weeks ago, wasn't it? When everything was a lot lower. I would have said HPQ as well is up there. I think that's incredibly cheap. Beatrice, we've mentioned them before, is still trading at cheap levels. I was looking at WP Carey, but they've bounced back quite nicely. I think they're over $80 now. I like them more when they're 60 to 70. But yeah, I think HPQ and Beatrice are my two main ones that are on sale at the moment, I would say.
Nice. That's nice. And are you buying them?
Yeah, I'm not buying any more Beatrice. I have them, but I am buying HPQ. So I'm buying them in smaller tranches, but I bought some last month and this month as well. So.
Yeah, nice one. Okay. And then I believe we came to the end of the listeners' questions for today. Oh no, wait! From Simon Stott, he's still one asking, like, what do you think of Michael Burry and co.'s concerns about ETF bubbles and ETF deteriorating pricing in markets, with so many physical and synthetic ETFs relying on the same big name stocks? So generally, do you think we're living in an ETF bubble?
Yes, I would say so. It's like a self-fulfilling prophecy, isn't it? And I haven't read this article. I will. It looks quite interesting, but it feels like, as you said, a lot of synthetic ETFs relying on a lot of big names, and if we do have an even bigger crash, it's not going to be good news, I don't think.
Yeah. So I'm thinking like this already also for a few years, and just from and actually I got this from Jim Cramer, who once mentioned that ETFs have just changed the stock market, because what's happening, people are just massively putting liquidity into ETFs because it's so nice, index investing. So you're not taking into account the fundamentals anymore. So you have this giant whale that is just pouring on a monthly basis money into the ETFs, and they just buy all these stocks. And of course, all Apple is in there, Microsoft is in there. So these companies go even up, without even maybe having the best track record or anything, just because they are popular. And that's what I think is the risk, that once the liquidity dries up, so if, for instance, we get a consumer crash, like a savings crash, that they need to pull out money out of the stock market, I think it reversively goes probably like twice as hard. But we haven't seen it yet, because I still think that consumers have, although inflation, but the ones that have been investing have still enough liquidity to pour money into the stock market.
There's still lots of liquidity. I think I've seen this was the record week or record year for Black Friday sales as well. So there's still money. I think I said that to you we haven't seen that capitulation yet and that fear.
No, exactly.
I got that fear during COVID. I'm not getting a sense of that fear yet.
No.
So that's why I still think we can drop further. But I mean, who knows?
Yeah. Good. That was it for this week. Thank you, everyone, actually, for waiting for us. It's been a Sunday morning. These are always maybe a little bit different in energy as well. But, every weekend we're rocking for you guys. And just thank you for staying so long with us.
Okay, and we will see you all next week.